Mr. Torres is recognized.
Thank you. When interest rates rise, long-term securities become less valuable, but deposits become more valuable. If you have a stable deposit base, the gains from the deposits can offset the losses from long-term securities. But if you have an unstable deposit base, like Silicon Valley Bank, there's no built-in offset. Silicon Valley Bank had a uniquely uninsured, unstable deposit base that made it singularly susceptible to a bank run in the age of social media. So, Vice Chair Barr, should a bank with an unstable, uninsured deposit base like SVB be subject to a higher standard of regulation than a bank with a stable, insured deposit base?
Representative Torres, I couldn't have said it better myself. I think you described the situation exactly correctly. And the unique...
Flattery will win you no points, but sure.
It's just the truth. I wish I had said it that way. But no, I think there are unique risks to this kind of heavy uninsured deposit base. And for most banks in the country, as you described, they handle their interest rate risk properly. They have stable deposits. You know, I know all of you, when you talk to your banks and you go back home across the country, they're doing okay.
But you agree that the rigor of regulation should depend not only on size, but on deposit stability, yes?
I do.
Regarding commercial real estate, the rapid rise of work from home during COVID has driven down office property values, and the rapid rise of interest rates have driven up financing costs, creating a perfect storm. Office buildings with declining property values are set to be refinanced at far higher interest rates. There's reportedly $2.5 trillion in commercial real estate debt coming due over the next 5 years, a substantial share of which is office debt. Chair Gruenberg, to what extent do you worry about the office loan portfolio representing a ticking time bomb in the banking system?
It presents a risk. It's one the FDIC has talked about and identified publicly.
And Signature was the largest commercial real estate lender in New York City. How much of Signature's commercial real estate portfolio consists of office real estate?
That's a good question. Let me get you the exact number. It's a substantial portion of it.
Can you get me back an answer in writing?
I can get that for you.
More important to me locally, residential real estate. Signature Bridge Bank has a housing portfolio of 3,000 properties consisting of 80,000 units in New York City. The portfolio includes 479 properties consisting of 19,000 units in the Bronx, where I serve as a congressman. I have two questions for the FDIC. As you go through the process of seeking a buyer for Signature's residential real estate debt, to what extent will you seek the input of New York State and New York City housing officials who have an obvious stake in preserving the affordability of these properties and units? And to what extent will you prioritize affordable housing preservation in your selection of a purchaser?
Thank you, Congressman. Just to be clear, we have sold Signature to New York Community Bank.
You sold everything but the real estate portfolio, as I understand. That's been publicly reported.
I take your point. No, we'll be glad to work with you and other local officials in New York in regard to the disposition.
I appreciate that commitment.
Sure.
I'm not advocating the following course of action, but I want to provide you with a hypothetical. The banking system is reportedly sitting on more than $600 billion in unrealized losses from securities, and those losses will only rise with rising interest rates. Since the problem with these assets is one of asset duration rather than asset quality, should the Federal Reserve consider purchasing these securities? Unlike a bank, which needs liquidity to honor obligations to depositors, the Federal Reserve has the ability to hold these assets to a maturity without realizing those unrealized losses. Wouldn't that solve the problem?
You raise an excellent point. Under existing law, we cannot do asset purchases. But what we do is provide ample liquidity to the financial system on the basis of those
But the
assets.
losses remain, even with the emergency liquidity, the losses remain on the balance sheet. Those losses are arguably undercutting public confidence in the banking system. And as you know, banking is as much about psychology as it is about finance. Why not just remove the losses?
I'd go back to the first point you made in your earlier question, which is that for most banks, they're managing this well. They're doing fine. They have stable deposits, and they don't need to sell the assets they have on their balance sheet. Those assets can stay there and be held to maturity. If institutions need liquidity, they can get access to that from the discount window, and from the program we established, the Bank Term Funding Program gives longer-term stability at par for those very assets.
I want to squeeze in one more question. Did the bank supervisor at the San Francisco Fed have the supervisory authority to prevent Silicon Valley Bank from investing in unhedged long-term securities? Did you have that authority? Like, is the problem a lack of authority or a failure to exercise the authority you had?
The bank examiners cited them for not behaving properly with respect.
But did they have the authority to prevent it?
The gentleman's time has expired. The gentleman can answer on the record. The gentleman from South Carolina, Mr. Timmons, is recognized.